Hello everyone and welcome back to another video. In today's video, there is a lot that I want to discuss, so here are the key topics that we are going to go through. ASML just reported its earnings and the stock is down at 10% at the time of recording this video, and I want to discuss if this stock is looking cheap and attractive today. Perplexity is continuing to attack Google Chrome, and the CEO is directly saying that they want to disrupt Google. I also want to discuss the Nasdaq and S&P's price multiples today with some new and updated charts. Berkshire stock has been selling off since Buffett announced that he is going to be stepping down as CEO. And I want to share what my thoughts are on Berkshire stock now and the business as a whole. There's a new ETF with an over 100% dividend yield that a lot of people on social media are buying and talking about. So I want to share my thoughts on this ETF and the risks surrounding it, and just update you with some of the things that you really should just be watching out for when you're considering buying stocks and ETFs. Then we will be discussing Trump wanting to fire Jerome Powell, and I want to share my thoughts on why he's doing this, and if I think this is a good idea. And you can probably tell by my facial reactions what I'm already thinking there. Then we will be discussing Brookfield stock as it is hitting fresh all-time highs today, and there has been a lot of news recently coming out surrounding Brookfield, so I want to cover that news pretty quickly. And then lastly, I want to respond to some great and interesting comments that I got on my previous video that I think will add value to everyone watching this video. So this is going to be another action-packed video, so let's just hop right into it and get started by talking about ASML's recent earnings report. As always, I went through ASML's report and I took some screenshots of all of the key highlights that I think investors need to know. So this is their investor key messages from the most recent earnings report, and this says, the semiconductor industry remains strong, driven by artificial intelligence adoption across an expanding application space and is expected to surpass $1 trillion in revenue by 2030. Our customers remain at the core of our strategy, and we believe that lithography will remain at the heart of their innovation. We see an opportunity to achieve 2030 annual revenue between approximately 44 billion euros and 60 billion euros, with a gross margin between approximately 56% and 60%. We expect to continue to return significant amounts of capital to our shareholders through growing dividends and share buybacks. So what I am getting from the investor key messages is basically that nothing has really changed for ASML's business over the long term. They're still at the heart of all of the artificial intelligence technology. They're literally the foundation that allows companies to build chips that power AI. And their long-term revenue guidance for 2030 is remaining intact. They haven't changed it at all. So let's continue on through the earnings report to see what is going on here and why the stock dropped today. This next screenshot shows us ASML's income statement for this quarter. And we can see that net system sales were 5.6 billion euros on the quarter, up from 4.8 billion last year. Total net sales also came in at roughly 7.7 billion, which is up roughly 20% year over year. The company's gross profits also increased dramatically by almost 30% year over year, and the income from operations is up roughly 800 million euros year over year, which is growth of over 40%. We can also see that net income came in at roughly 2.3 billion, which was an increase of roughly 700 million euros, which was another growth rate of over 40% year over year. So again, ASML had a very strong second quarter. So then the question is, why is the stock down so much today, and why are investors reacting so poorly? And the reason is because of the outlook. So let's see what the CEO says here. Our second quarter total net sales came in at 7.7 billion, at the top end of our guidance. The gross margin was 53.7% above guidance, primarily driven by higher upgrade business and one-off resulting in lower costs. Looking at 2026, we see that our AI customers' fundamentals remain strong. At the same time, we continue to see increasing uncertainty driven by macroeconomic and geopolitical developments. Therefore, while we still prepare for growth in 2026, we cannot confirm it at this stage. And this is what investors are freaking out about, in my opinion. And the quotes that I have seen across social media are taking this one paragraph a little bit out of context and saying that the CEO is saying that the company is not going to grow at all in 2026. But in my opinion, that is not what the CEO is saying here. What the CEO is saying here is that their customers' fundamentals are remaining strong. They are preparing the business for growth in 2026, but they cannot confirm growth in 2026 for their investors. So they're saying that they cannot confirm that the business is going to grow next year, but everything as it stands today looks like it should grow. This, in my opinion, is the CEO being a little bit pessimistic, maybe sandbagging a little bit. and just not wanting to promise investors anything given the macroeconomic uncertainty that is going on, all of the tariffs and the geopolitical uncertainty as well. But at its base, I think the company still looks like it is strong and its long-term fundamentals are going to be just fine. The CEO also gave guidance for the third quarter where he said, "We expect third quarter total net sales to be between 7.4 and 7.9 billion euros, with a gross margin between 50% and 52%. Now, this third quarter guidance was a little bit on the weaker end. And if we take a look here, the total net sales for the third quarter of 2024 were about $7.47 billion, and the gross margin was about 50.8%. Now, once again, if we go back to the outlook for the third quarter of 2025, it means that they're not expecting revenues to really grow all that much. Revenues could actually be flat to only seeing slight single-digit growth for the third quarter of 2025, and the gross margin is projected to be roughly the same at around 51% in the mid-range there. So it seems like the next quarter could be a little bit weaker, and I think that this guidance for the next quarter is also why investors were a little bit fearful and panicking, in my opinion, this morning. This next screenshot shows us ASML's quarterly net bookings, and we can see that the trend is overall declining and has been declining for about a year now. Quarterly net bookings are actually down slightly year over year for the June quarter, and I think that this could be another reason why investors are selling off the stock today and why the stock is ultimately down. The quarterly net bookings being slightly down year over year is definitely not a bullish thing, but again, over the long term, I do think that ASML's business is going to be just fine. In my opinion, the best metric to value AMSL's business is the price to operating income ratio. And in the trailing 12 months after this updated report, ASML is trading for about 26.5 times operating income. Now, if we head over to Stock Unlock's freeform tool here and we take a look at about the past decade, we can see that ASML's average price to operating income has been about 31.7. This means that the stock is trading well below its historical averages now by about 15 to 20%. So it does look like, based on this metric and how the market has historically valued this business, it could be selling for a little bit of a discount today. I don't necessarily think that this is a massive discount, like I need to go out and buy this stock right now, it's the best deal in the entire market, but it's definitely trading for a slight discount to its historical averages and therefore could be looking slightly attractive today. Now, I also ran 3 discounted cash flow calculations on ASML's business using its operating income projections out to 2030. This is basically a 5-year operating income projection. And in the mid-range, they are projecting to grow operating income by about 8% annually out to 2025. So that is what I have in this first screenshot right here. And I also have ASML trading for a 30 price to operating income, which is slightly below their 10-year average of 31.7 that we saw earlier. So if ASML can hit the mid-range of their guidance with that 8% operating income growth over the next 5 years, then the stock could compound by about 16.6% annually out to 2030, which obviously is a great compounded annual growth rate to the share price that also is above the S&P 500's historical return of about 10% annually. This next screenshot reflects ASML hitting the high end of their revenue guidance, and I applied a 33% operating margin, which would result in a 12.3% compounded annual growth rate to ASML's operating income from today. And if ASML can hit the high end of their guidance, then the stock could compound by about 21% annually, which is a very high rate of return. Now, this last screenshot is if ASML comes in at the low end of their 2030 guidance, which would be about 6% annual operating income growth. And even on the low end of their guidance, if they can maintain that 30 price to operating income ratio, then the stock could compound by roughly 14.5% annually, which in my opinion is still a pretty good rate of return, and the fair value would be about $913 today. So what these discounted cash flow calculations are showing us is that if ASML can meet their guidance by 2030 and maintain a price to operating income ratio of at least 30, then the stock could be looking like it is below fair value today. So then the question is, am I buying ASML shares? And the answer is no. For me, ASML is out of my circle of competence. I actually did about a 30-minute video dedicated to this business on my YouTube channel. And the conclusion of that video was, this one is extremely hard to understand. This company basically has the most intricate technology and most advanced technology in the world, but there are competitors that are constantly trying to replicate what ASML can do. And it's just a little bit too confusing for me to know if this company is truly going to have a moat for the next decade or not, when there's a lot of companies and countries trying to replicate what they do. So they've been very strong so far. Their moat has remained intact so far, but if I'm being honest with myself, this technology is just a little bit out of my circle of competence. I also think a 30 price to operating income ratio for a business that is projecting to grow its operating income from about 6 to 12% over the next 5 years is a pretty high premium to pay. That premium is basically saying that ASML does have one of the strongest moats in the world and investors are willing to pay for it. But in my opinion, I think there are better stocks out there that are trading for lower multiples and seeing much higher growth rates. And that is where I am focusing my attention instead. So to wrap that up, I think that this one is out of my circle of competence, and I think that its price multiple relative to its growth rates are quite high, and that's why I personally am not interested in ASML shares today. All right, let's now move on to the next topic that I want to discuss, which is Perplexity continuing to go after Google Chrome. This is the CEO of Perplexity on X, and they put out this tweet recently that said, "Who wants to read all of your emails when AI can read it for you?" I actually discussed this in my last video that I put out last week, where I shared a demo of Perplexity's new web browser, Comet, going through someone's emails and unsubscribing them from all of the spam so that they could clean up their inbox. Comet also summarized the user's emails and gave them a quick overview and then responded to the emails and even set up calendar appointments, which basically means that Comet is like an AI agent powered web browser. And I think that ultimately what this is going to do is cause Google Chrome to innovate. I think that these new AI web browsers are going to force Google to dance, if we want to use Microsoft CEO's words. And ultimately what I think is going to happen is Google Chrome is going to get better from all of this. But I want to play a quick clip of Perplexity's CEO in an interview that he did talking about Google Chrome and how Perplexity is really wanting to attack Google's business. So I'm going to play that clip and then we'll discuss it afterwards.
With the scale and resources of a platform like Meta or an Apple or a big tech company?
I mean, I think the world needs like little tech to win, right? If it's all about big tech winning all the time, then there's no interest. I think AI is the first time there's opportunity for a new player to come and disrupt the existing market. And the big tech can still keep winning. Like, for example, Meta can make their existing suite of products better with AI, or Apple can make their phones sell better with AI. And Perplexity can still exist on all these platforms and have its own business. And our goal is actually to give an alternative to the world to Google, Google Chrome, Google Search, and like Google Assistant, Gemini, like all the workspace integrations they have done. There needs to be an alternative for that. Like, that is the true monopoly, like 90% market share. And we got to go for that. And if we don't try, then nobody else will.
In this clip, Perplexity CEO very clearly said that their mission is to be an alternative to Google Chrome. Then he says that Google has had a 90% market share for years, and that is what they are going after. The company is quite literally, its mission is to attack Google's moat and take some of its market share in Chrome and LLMs and even in search. And I don't necessarily know how this is going to work out for Perplexity long term, because if you guys remember, I think it was in 2023, Satya, the CEO of Microsoft, was saying that he wanted to make Google dance and he was investing in Bing to try and take Google's market share. That has absolutely not worked. Bing has not made a dent in Google Chrome's market share. So I'm not necessarily optimistic or bullish that Perplexity is going to have any more success. And in my opinion, what's going to happen here is Google is for sure watching Perplexity. Like, everyone knows about Perplexity, everyone knows about Comet, so there's no way that Google doesn't know about them at this point. So what Google tends to do is allow these other companies to innovate, put out new products, and see what resonates with the marketplace. And then they kind of take the best features, the ones that users like, and then they implement them into Google Chrome or their Gmail or things like that. So that's why I say, I think Perplexity is going to force Google Chrome to innovate. And I'm personally not optimistic that Perplexity is actually going to disrupt Google in any meaningful way, especially because their Comet browser is launching at a $200 per month price tag. There's just no way that your average consumer is going to pay $2,400 per year to use a web browser when web browsers have been free for decades now. And that is the main competitive advantage that Google has over all of these companies that are trying to attack their moat immediately. Google's business is run on ads, and how it runs on ads and how it's able to generate so much advertising revenue is because they have literally billions of users on multiple different products. And when you have that kind of distribution, you can charge advertising fees and place ads across your platform, and billions of people are going to see it. So obviously that is very attractive for advertisers who want to get their product in front of billions of people. Now, when you talk about Perplexity, this is still a small company. They don't have billions of people using their products or their web browser. So what they have to do is charge a subscription fee to generate revenue to make it an actual viable business product for their business, so that the company doesn't just burn all their cash right away immediately. So these new companies coming in, they don't have the distribution potential that Google has, and therefore they cannot sell advertisements at nearly as high of margins. So I'm not bullish on the overall business model of charging a high subscription to use a browser in the first place. And then I'm also more bullish that Google is just going to take whatever resonates with consumers and apply it to Google Chrome, and then everyone's going to be happy in the end. I think the net result is that users are going to get a better Google Chrome experience and a better Gmail experience as well. That would be my speculation on the outcome here. And now on a completely different but kind of related topic is I think the Perplexity CEO is a little bit overconfident. I don't know why, and it's hard for me to put my finger on it, but when I listen to him in interviews, and I've listened to a Lex Fridman podcast with him as well, it was like 2 hours long, he just comes across as extremely overconfident. And I don't think that that's necessarily the best thing when you're a CEO of a company, especially one that's getting a lot of hype and a lot of attention. So for example, one of the things that he said in the Lex Fridman podcast that really rubbed me the wrong way is he was trying to identify why Google did not invest in the cloud earlier. Like, why was Amazon the first company to really dive in and invest in the cloud? And his argument was Google waited because the cloud business was a lower margin business than the overall Google advertising business. And the Perplexity CEO said, Google does not want to invest in anything that lowers the company's overall margin, because if it's lowering the margin, then it's not actually good for the business. This is completely the wrong way to think about it, in my opinion. What matters the most for a business and what creates the most shareholder value is if your profits per share continue to grow over the long term. So Google investing in Google Cloud, for example, would still be worth it for their shareholders as long as the profits per share of the business continue to grow. Even if their gross margin or operating margin comes down a little bit, if the overall profits of the business on a per share basis are growing, then that is what creates and grows shareholder value. What doesn't create and grow shareholder value is maintaining your high profit margin. You can sacrifice some of your profit margin if it means you generate a lot more revenue and your profits per share grow. So the Perplexity CEO basically saying that it's not in any company's best interest to invest in anything that could potentially lower the business's overall margin was really weird, and I don't think a good business sense. And he said it with such conviction and with such confidence. And as an investor, I was just like, that makes absolutely no freaking sense to me personally. So yeah, he kind of rubs me the wrong way. And I don't know if that has any impact on what anyone should think about the business or not, but that's just kind of my opinion on the guy and everything going on with Perplexity, because there's a lot of talk about Perplexity and Comet taking Google market share right now. But with that being said, let's move on to the next topic that I want to discuss, which comes from this screenshot right here. I was scrolling on X the other day, and I saw that the 10 companies in the Nasdaq now make up over 50% of the entire Nasdaq allocation. These top 10 companies are NVIDIA, Microsoft, Apple, Amazon, AVGO or Broadcom, Google, Meta, Netflix, Tesla, and Costco. Now, when I saw this image, it really put into perspective how freaking expensive the Nasdaq actually is now. When I take a look at these top 10 companies, there's only two that I think are potentially selling for even fair value today. That is Amazon and Google, where I put the arrows here. I think that you can make an argument that Amazon and Google are selling for around fair value today. I don't even think that these two companies are necessarily undervalued or offering, extreme value today. I think they're around fair value. But Costco, for example, I think is massively overvalued. Tesla, massively overvalued. Netflix. I think Netflix is also extremely expensive. I think Meta is on the expensive end, but I don't think that it's massively overvalued. Broadcom, I think massively overvalued. Apple, massively overvalued. Microsoft, overvalued. And Nvidia, also overvalued. So over 50% of the Nasdaq ETF now, I think, is in companies that are extremely expensive. And this is why I think that the Nasdaq going forward is probably going to produce pretty low returns, simply because the price multiples have just gotten so freaking high. And I actually have this chart right here, which is the historical price to earnings ratio of the Nasdaq and its current price to earnings ratio. And it's a 20-year chart here. And we can see that the current PE of the Nasdaq is now sitting at 40.7, which is significantly above its historical averages. Its historical average is 21, so it's almost doubled its historical average price multiple. And I mean, even back here in 2021, when the market got quite expensive, the Nasdaq's price to earnings ratio was around 33. So the Nasdaq is significantly more expensive than it was even in 2021, before the market had that 25% correction. Now, this next screenshot is the S&P 500, and on a trailing 12 months basis, the S&P is now trading for about 30 times earnings. And if we take a look at history, this is also extremely expensive, okay? So even the S&P, not even the Nasdaq, but the S&P now is getting on the very expensive end, in my opinion. This screenshot right here is the 12-month forward price to earnings ratio relative to the past 20 years. And we can see that the S&P is basically at the very high end there. It's the most expensive it has been over the past 20 years. Now, every time I talk about the S&P 500 or the Nasdaq price to earnings ratios or their multiples today, I get comments on every single video saying, well, you know, the companies in the Nasdaq and the S&P are higher quality than they've ever been over the past 20 years, and therefore that should command a higher multiple. I completely agree with you, by the way. I do think that there is justification that the S&P should trade for a higher multiple relative to its history. Same with the Nasdaq. Well, the S&P and the Nasdaq. I actually don't know if I just mixed up my words there. But I do agree. When you have higher quality and you have higher growth, you should command a higher multiple. But we're at the point now where, as a whole, as a whole, okay, the S&P, in my opinion, is still very expensive. It's trading for a price to earnings ratio, as we saw, of about 30 today. And I believe analysts are expecting the earnings of the S&P to grow by roughly 10 to 12% over the next 3 years. So when I take a look at that, I'm seeing, if you want to just bucket the ETF as a stock, basically, it's trading for 30 times earnings, and it's projected to grow by 10 to 12% over the next 3 years. So that's a 30 multiple for 10 to 12% growth. That's still very expensive, in my opinion. I'm finding stocks in the market that are trading for significantly lower multiples and projecting significantly more growth. And this is the heart of why I personally am not investing in ETFs. I do not own a single ETF in my portfolio, and I am not interested in buying any of the US indexes today. Because relative to what I am able to find in the market, the indexes just simply don't look attractive at all right now. And I think that they do actually look quite freaking expensive. Now, this last chart comes from JP Morgan's Guide to the Market, and they recently updated their charts. So I want to share this one right here. This is the S&P 500's forward price to earnings ratio, which we can see is 22x right now. And in January of 2022, which was the previous high before the market corrected 25% in 2022, the forward price to earnings ratio was 21.4. Now, at this time, the 10-year bond yield was 1.6%, which could have justified that higher price multiple. Because when interest rates and bond yields rise, it tends to cause price multiples and asset prices or asset values to come down, because you can get a higher return for taking on no risk. Well, today, the forward price to earnings ratio of the S&P is sitting at 22, and the bond yield is 4.2%. So it's not just that the price multiple of the S&P is higher today, it's also that bond yields, the risk-free rate, is almost 3 times as high. It's about 2.5 times as high. So when you factor that in as well, it ultimately means that the S&P is looking a lot more expensive today. Now, we do have a reference here from the tech bubble, and during the tech bubble, the peak forward price to earnings ratio was 25.2, and at that time, the 10-year treasury was 6.2%. So I don't necessarily think that we're in bubble territory right now, because during the peak of the tech bubble, the forward PE was higher, and the 10-year government bond yield, or the risk-free rate, was also higher. And that combination leads me to believe that the tech bubble was extremely expensive. And once again, we're not quite there yet. but I do think that the market is definitely looking very expensive right now. And that just confirms why I have not been as interested in US stocks or in the US indexes as a whole overall. And with that being said, that is going to wrap up my thoughts on the prices of the Nasdaq and the S&P 500 today, and my justification for thinking that they are quite freaking expensive. So moving on to the next topic, this one is Berkshire Hathaway now underperforming the S&P 500 by quite a wide margin since Warren Buffett has announced that he's going to step down as CEO at the end of the year. So this chart right here shows the S&P 500 and Berkshire's share price on the literal day that Warren Buffett announced that he is going to be retiring as CEO. And we can see that since then, the S&P is up 10.1% and Berkshire stock is down 11%, which means that Berkshire is now underperforming the S&P 500 since that announcement by about 21%, which is a pretty wide freaking range. So it's pretty clear that investors and the market as a whole are not as optimistic or bullish on Berkshire after Warren Buffett announced that he is going to step down. I mean, typically, you would expect Berkshire to move with the overall S&P 500, especially since it is a pretty large portion and one of the largest stocks in the entire S&P. So I want to share my thoughts on Berkshire stock today and why I personally do not own it. So this goes back to me reading The Snowball, which is a book that's dedicated to explaining Warren Buffett's life. It's kind of like a biography on Warren Buffett. It's written by Alice Schroeder. Fantastic book. If you're a Buffett fan, I would strongly recommend reading this book. It's very long. It's like 700 pages, but it really goes in depth. It's the most in-depth piece of work that I've ever seen on Buffett. Now, with that being said, after I read The Snowball, it became absolutely clear to me that there is only ever going to be one Warren Buffett. This guy was, he dedicated his entire life to producing the highest investment returns that a human can possibly achieve, in my opinion. Like, there was a period in the book where Buffett was so focused on the next deal, finding the next investment, that his employees and the people close to him were making fun of him, saying, if you walked by your kids on the street, you wouldn't even recognize them. Now, that's actually kind of sad. That's not the life I want to live personally. Like, if I do end up having kids, I definitely want to be close with them and I want to spend a lot of family time with them. And I will sacrifice some of my investment returns to do that. I'm completely fine doing that. Buffett wasn't. Buffett was freaking ruthless. Buffett was 100% focused on getting the highest return, finding the next deal, and producing the most shareholder value for him, his partners, and Berkshire Hathaway. I don't think that there's ever going to be anyone that has the combination of genius, focus, dedication, and a love for investing. To put it simply, Buffett is one of a kind. And now that Berkshire is not going to have this absolute master of investing leading the business, I think that the future outlook of the company is worse off. Straight up. I just think it is, because you simply cannot replace Buffett. He's irreplaceable. Now, I do think that Berkshire will do fine because the business is very solid. They got a lot of high quality companies in there, and it's going to continue producing cash for decades, if not centuries to come. So I think that Berkshire's share price will continue to rise. The business will continue to compound. I just think that the rate of compounding is going to be lower going forward. One, because Buffett is irreplaceable. And two, because Berkshire is now a $1 trillion company, and it's becoming pretty clear that they don't know what to do with their cash anymore. I have a screenshot right here of Berkshire Hathaway's balance sheet as of their most recent quarter, and we can see that their cash and cash equivalents are sitting at $37 billion, and their short-term investments and US Treasury bills are now sitting at $305 billion. And as a whole, Berkshire has roughly $350 billion in cash now. That's crazy, okay? That's like 35-ish% of the company's entire market cap is sitting in cash, and they don't know how to deploy it anymore. Like, this company is generating so much cash now, and it's just building up on the balance sheet at a significantly faster rate than they can deploy it. Like, even if we saw a stock market crash next year, I'm not confident that this team would know how to deploy $350 billion of cash into high return investments, which basically means that a lot of their cash is going to just go into treasury bills that are going to produce probably 4 to 5%, which is not a very high rate of return. And if that cash position continues to grow and become a larger and larger portion of Berkshire's business, then that's going to continue to lower the overall returns of the company if that cash position is getting a lower return than the overall business. That's a long way for me to say that I think Berkshire is officially struggling from its size now. And I don't necessarily know how the company is going to solve this, especially with Buffett being gone. And what I would speculate is they're probably going to start paying a dividend within the next 3 to 5 years, because there's just so much cash piling up on the balance sheet. And Berkshire stock, in my opinion, also isn't even cheap today. So buybacks don't even make sense, which is probably why they're not putting the gas pedal down on buybacks, because this is a $1 trillion company that's trading for about 21 times operating earnings now, which I think is a pretty high price for this business. Yeah, they're just kind of in this bad situation where they're just producing so much cash, they have so much cash, and I don't think they know what to do with it anymore. And I think that's going to ultimately impact the company's future returns. And that with Buffett leaving, you know, I just don't think that the company is in a very good spot specifically for producing high rates of returns going forward. And that's why I don't own it. Like, don't get me wrong. Again, I think this company is going to continue to grow. It's going to continue to produce cash. It's probably going to continue compounding by 6 to 10% per year. But that's not what I'm looking for. I'm here to try and outperform the S&P 500. And 6 to 8% annual returns, 6 to 10% annual returns are not exciting enough, and that's not what I want in my portfolio. And I think that's what Berkshire Hathaway is going to produce. And since that's the case, it's not meant for my portfolio anymore. Now, for someone who may want a fortress of a business and may want a business that's has a very low chance of losing money over the next 30 years, Berkshire Hathaway fits the bill perfectly. But for me, and with my goals of wanting to outperform the S&P 500, it does not fit my goals. And that's why I don't own it. And that's my perspective on Berkshire Hathaway now. And personally, I'm not surprised to see that the stock is underperforming the S&P since Buffett left. So let's move on to the next topic that I want to discuss. And this one is in regards to that ETF that has a 100% dividend yield now. The ticker symbol of this ETF is MSTY, which is the Yield Max MSTR Option Income Strategy ETF. And we can see here that this ETF has a dividend yield of 120% in the trailing 12 months. It's a $22.86 ETF right now. And if we go and take a look at its dividends, it pays a monthly dividend. And last month it was $1.23, $1.47, $2.37. And you can see that it's paid out a lot of freaking income since it hit the market in 2024. So I'm seeing a lot of people talk about this ETF. They're seeing the 120% dividend yield. And people are like, why don't we just buy this stock? Like, here, let me show you some screenshots that I found on X. This one says, started a position in MSTY today, bought 25,000 shares in 4 different accounts. August returns are going to be fire. This next screenshot says, MSTY is up 10% in 3 months. During those 3 months, we've had payments of $2.37 per share, $1.47, $1.24, easy money, free money. Why are more people not doing this? So there's posts coming out now on social media that this ETF is free money and everyone should own it. It should be in everyone's portfolio because it just produces so much freaking income and it's up 10% in 3 months. So how could you possibly lose money? So I went over to the ETF's website to see what does it actually do, okay? And this is what it says. Investing in the fund involves a high degree of single issuer risk. The fund strategy will cap its potential gains if MSTR shares increase in value. The fund strategy is subject to all potential losses if MSTR shares decrease in value, which may not be offset by income received from the fund. So MSTR is MicroStrategy, okay? This is the company that basically puts all of its money into Bitcoin, and it's essentially a leveraged Bitcoin company at this point because they just leverage themselves up. They take on debt to buy Bitcoin. That's the company, okay? So in my opinion, this company is an extremely risky company, especially as someone who is not necessarily bullish on crypto and Bitcoin as a whole. So this company, MSTR, is an extremely risky company. And then you take it one step further and you start writing options. You start writing covered call options on an extremely risky and volatile company. That's what MSTY is. So you take one of the most risky stocks in the market, in my opinion, and then you increase the risk by writing covered call options on that stock. And that's what you get, MSTY. This is an extremely, extremely risky ETF right here, okay? It's definitely not free money. And I have another screenshot. I was using Gemini and I asked it to explain the risks of MSTY. And here's what it said. Option strategy risk covered call. While covered calls can generate income, they come with their own set of risks. Capped upside. As mentioned, the strategy limits potential gains if MSTR stock price rises significantly. Full downside exposure. If MSTR's stock price declines, Misty is subject to the full extent of those losses, which may not be offset by the income received from selling the options. When you're writing these covered calls, okay, you have limited upside, but you have full downside. Like that just increases the risk of this ETF even more. So what I want to say is just do not get enticed when you see companies or ETFs with extremely high dividend yields. And what I've noticed throughout my investing career is the higher the yield, the more sketchy the product probably is, and the more skeptical you should be as an investor. So when I see a 120% dividend yield, like alarm bells go off in my brain. Everything in my brain is just like, just forget about it. Don't even look at it. Just move on. Just move on. You don't need to own it, okay? Just move on. And that's what's happening for me on this one. So it's interesting to see that people online are not really considering the risks, in my opinion, with this. And they're just thinking that this is free money. And they're even encouraging people to go and buy this and saying, hey, everyone should own it. Like, that's why I kind of just wanted to make this video and say, this is freaking risky. And I think people should be aware of that. And just some things that maybe you should consider when you're looking at ETFs and investment products as a whole. All right, now let's move on to the next topic that I want to discuss, which is Trump is trying to fire Powell, it seems, or at least that's what social media is leading us to believe right now. This, in my opinion, would be an absolutely awful thing for not just the Fed or the US economy, but for democracy as a whole. Because the point of the Fed is to be a completely independent and separate body from the presidency so that they have autonomy. Like, if you gave the president the ability to control interest rates, that would be an absolutely terrible thing for the United States economy. It would be crisis mode because every single president would be incentivized to put interest rates as low as possible so that the economy could run as hot as possible during their presidency. And then they would be like, oh, hey, look at me. During my presidency, the economy grew this much and interest rates are low. Money is free. Everyone feels good. Home prices are skyrocketing. Asset values are going up. Everyone's happy. That's what the president would be incentivized to do. That is what Trump is incentivized to do. That is why he is out there saying, we need to lower interest rates. We need to get the economy roaring. You know, debt is becoming too expensive, blah, blah, blah. We need to lower interest rates. It's because he knows it will stimulate the economy and it will cause asset prices to go up and it will cause the stock market to go up. And I think at this point, it's pretty clear that Trump looks at the stock market as kind of a gauge as to how he's doing as a president. He doesn't like to say that, but if you read between the lines, he's definitely looking at the stock market for confirmation of his presidency. If interest rates lower, the stock market will freaking rip. House prices will rip. Asset values will rip. And people will feel more wealthy. And I think he'll put that as a check mark on his box. Here's the thing, though. Peter Lynch has said before, Peter Lynch is an investor I really respect and admire. He said, the Fed's job is to take away the punch bowl just as the party is getting started. It's the Fed's job to make sure that the economy is not too weak or too hot. And I think that if we lower interest rates massively right now, it's going to cause the economy to get way too freaking hot. I mean, think about it. The S&P is at all-time highs. The Nasdaq is trading for a 41 price to earnings ratio. Bitcoin is going nuts. In my last video, I showed how I think Bitcoin and crypto is in its own freaking bubble right now. People seem extremely optimistic. Like, in my opinion, the market and the economy already feel hot and frothy. So I don't necessarily think that we need to lower interest rates right now. Like, you typically want to lower interest rates when the economy is weakening and when it needs stimulus. But I don't think that the US economy needs stimulus right now. I think there's an argument that you could actually raise interest rates due to how hot everything is running. The economy is clearly okay. And froth is out there. And this is kind of what Peter Lynch was saying, is when the party's getting started, when things are getting frothy, that's when you take away the punch bowl by actually raising interest rates. So yeah, I would be extremely concerned if Trump removed Powell, because I think Powell's actually doing the right thing and he's doing a good job by saying no and standing up to Trump. That's the job of the Fed. The job of the Fed is to stand up to the president when they're demanding you lower interest rates and you say, no, we don't need to. And I don't think the US needs to. That may be not the consensus right now, but that's my opinion. And I also think that investors should know that higher interest rates are actually in your best interest if you're a net buyer of stocks. Because if interest rates rise, it causes asset values to come down. And if you're a net buyer of stocks or you're a net buyer of assets, then you should actually want those assets to be as cheap as possible. And again, if interest rates go up, asset values go down. So if you're a buyer, you want asset values down, which means you want interest rates up. Like, if interest rates rise, it's going to feel very good in the short term. My home value is going to go up. My net worth is going to skyrocket. My stocks are going to go up. And it's going to feel good in the short term. But it's not actually what's best for investors long term. What's best for investors long term who are net buyers of assets, which I think is the majority of people watching my videos, is actually for asset values to go down. Higher interest rates would do that for us. So I think people just need to calm down on this interest rate thing a little bit, in my opinion. And I think there's a pretty good argument that interest rates don't need to come down. And if Trump actually fires Powell, it's going to be kind of concerning, because that's going to be the president trying to get involved in monetary policy, which I don't think should happen. I think it's very good that they're separate and the president does not have power over monetary policy. And I think it should stay that way. I think it has to stay that way. That's my opinion. I do not think that Trump should be getting involved there, and I think Powell is doing a good job. Now, moving on to the last topic, this one is in regards to Brookfield. Brookfield has had a lot of news coming out with it, and the stock is hitting fresh all-time highs. Now, if you've been watching my channel for a while, you know that Brookfield is the largest position in my portfolio. It makes up 25% of all of my portfolios. It's basically 25% of my net worth. It's my largest position by far, and I'm very happy to see that the stock is doing well. It's just good to see it. So I want to share some of the news that came out recently. The first one is Westinghouse plans to build 10 large nuclear reactors in the United States. Westinghouse is basically half owned by Brookfield, and Westinghouse is one of the best and highest quality nuclear companies in the world. So take a look at what this article says. Westinghouse plans to build 10 large nuclear reactors in the US with construction to begin by 2030. Westinghouse's big AP1000 reactor generates enough electricity to power more than 750,000 homes, according to the company. Building 10 of these reactors would drive $75 billion of economic value across the US and $6 billion in Pennsylvania. Trump issued 4 executive orders in May that aim to quadruple nuclear power in the US by 2050. The US has only built 2 nuclear reactors over the past 30 years, both of which were Westinghouse AP1000s at Plant Vogtle and Waysboro in Georgia. The industry stalwart emerged from bankruptcy in 2018 and is now owned by Canadian uranium miner Cameco and Brookfield Asset Management. So Westinghouse is the company that has built the 2 nuclear reactors in the US over the past 30 years. They're the only company building nuclear reactors in the US over the past 30 years. And now it sounds like they want to build 10 more starting by at least 2030. This is obviously great news for Brookfield and for the nuclear industry as a whole. Now, why there needs to be more nuclear reactors in the United States is because US data centers will need twice as much grid power in 2028 as at the end of last year. The amount of power that these AI companies need and these data centers need is absolutely mind-boggling. So if the United States wants to stay on top of AI and they want to be the leader in AI, then they need a lot more energy. Brookfield is one of the companies that is going to supply the energy that AI companies need and that data centers need. That's pretty much one of the entire investment theses of Brookfield. There's a lot of investment thesis with Brookfield, but I think it's almost a sure thing that Brookfield's business is going to benefit from the growth of AI because of the simple need for raw power. And again, Brookfield is one of the companies supplying that power. So let's move on to the next screenshot, which comes from Mark Zuckerberg, actually. Take a look at this. For our superintelligence effort, I'm focused on building the most elite and talented, dense team in the industry. We're also going to invest hundreds of billions of dollars into compute to build superintelligence. We have the capital from our business to do this. Semi-Analysis just reported that Meta is on track to be the first lab to bring a 1 gigawatt plus super cluster online. We're actually building several multi-gigawatt clusters. We're calling the first one Prometheus, and it's coming online in 2026. We're also building Hyperion, which will be able to scale up to 5 gigawatts over several years. We're building multiple more Titan clusters as well. Just one of these covers a significant part of the footprint of Manhattan. Meta Superintelligence Labs will have industry-leading levels of compute and by far the greatest compute per researcher. I'm looking forward to working with the top researchers to advance the frontier. So Meta is investing hundreds of billions of dollars into more compute and data centers over the coming years, and these massive data centers are going to need a massive amount of power, and Brookfield is one of the companies supplying this power. In fact, on July 15th, just a couple of days ago, Brookfield and Google signed a hydro framework agreement to deliver up to 3,000 megawatts of homegrown energy in the United States. This is the world's largest framework agreement for the purchase of hydroelectricity. The contract is also worth over $3 billion. And in this article, it says, Brookfield and Google will initially focus on the mid-Atlantic and mid-continent electricity markets, with the flexibility to expand into other U.S. regions. The 20-year power purchase agreement for Brookfield's Holtwold and Safe Harbor hydroelectric facilities in Pennsylvania will support Google's operations across PJM, or the Mid-Atlantic region. So this power purchase agreement is the largest hydroelectricity agreement in the world. It gives Brookfield 20 years of stable income that's probably also going to grow, and the contract is worth over $3 billion, and they partnered with Google, which is one of the highest quality companies in the world. Brookfield also signed a $10 billion deal with Microsoft last year, and now they're signing deals with Google, and I wouldn't be surprised if they start signing deals with Meta. So Brookfield is absolutely killing it. I am not surprised to see that the stock is trading for all-time highs, and I surprisingly still think that the stock is cheap today. So congratulations to everyone who has Brookfield in your portfolio. I think that this is one of the highest quality companies in the world. I think that it is phenomenally run. I love the management team. I think that they have decades of runway left ahead of them. And for all those reasons, it's the largest position in my portfolio. And I've actually continued to buy shares over the past week. You know, in my Patreon community, I've let everyone know, hey, I'm buying more Brookfield shares. I'm nibbling on some more because I do believe that the stock is still undervalued, even though it is trading for all-time highs. I think the tailwinds here are just massive and they're going to last decades. So I'm going to wrap up the video now. I know I wanted to talk about some YouTube comments, but I can feel my voice going out. This video is getting very long. So I'm going to wrap up the video there. So if you made it to the end of the video, then thank you so much. I truly do appreciate you. And if you enjoyed the video, then please remember to leave a like on it. And if you're new here and you want to see more content like this, then please consider subscribing to my channel as well. With all that being said, thank you all so much again for tuning in. I truly do appreciate it. And I hope to see you all again in my next video.